If you are 65 or older and you filed your taxes recently without knowing this, there is a real chance you left money on the table. Not a few dollars, not a small adjustment, potentially thousands of dollars that legally belong to you. According to official IRS guidance, seniors age 65 and above may qualify for a combined tax benefit worth up to $12,000 or more, depending on their situation. And here's the part that should get your attention. The majority of eligible people either do not know about it or do not claim it correctly. This is not a new stimulus program. It's not a special check. And it's not something you apply for separately. These are existing provisions inside the tax code that have been there for years, updated for the latest tax cycle, and still widely overlooked. And that's exactly why this matters, because many seniors either file simple returns themselves or rely on someone else to prepare them. And when that happens, certain provisions, especially the ones that require extra attention, are often missed. In this video, we're going to break this down clearly and step by step. We'll walk through what this benefit actually is, how it works, who qualifies, what actions you should take, and the common mistakes that cause people to miss out on money that is already theirs. Everything here is based on publicly available IRS documents and official tax code provisions. So let's start with the foundation, because the entire benefit begins with something simple but powerful. The standard deduction. Every taxpayer in the United States has two choices when filing taxes. You can either itemize your deductions, listing out expenses like mortgage interest, medical costs, and charitable donations. Or you can take the standard deduction, which is a flat amount the IRS allows you to subtract from your income before calculating your taxes. For many seniors, especially those who no longer have large deductible expenses, the standard deduction is the better option. But here is what most people overlook. If you are 65 or older, the IRS gives you a higher standard deduction automatically. For the 2024 tax year, the base standard deduction for a single filer is $14,600. But if you are 65 or older, you receive an additional $1,950. That brings your total deduction to $16,550. For married couples filing jointly, the numbers become even more important. Each spouse aged 65 or older receives an additional $1,550, which means a married couple over 65 can receive a total standard deduction of $30,700. Compare that to a younger couple receiving $29,200. That difference may not sound dramatic at first, but it directly reduces the amount of income you are taxed on, and that reduction can translate into real savings. If you are in a typical tax bracket, that additional deduction alone can save you hundreds of dollars immediately. But this is just the first layer, because the real impact doesn't come from the deduction alone. It comes from how that deduction interacts with another major part of retirement income, Social Security, and that is where the benefit becomes much more significant. Now let's move into the part where the real impact starts to show up, because the higher standard deduction by itself is helpful. But when it interacts with Social Security taxation, that's where the numbers become much more meaningful. Many seniors believe that Social Security income is not taxed. And that is partially true, but it depends entirely on your total income level. The IRS uses something called combined income to determine whether your Social Security benefits are taxable. And this is where things get a little more technical, but also much more important. Your combined income is calculated by taking your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits. That total number determines how much of your Social Security income is subject to tax. For a single filer, if your combined income is below $25,000, your Social Security is not taxed at all. Between $25,000 and $34,000, up to 50% of your benefits may be taxed. Above $34,000, up to 85% of your benefits can become taxable. For married couples, filing jointly. The thresholds are $32,000 and $44,000. Now, here's where the higher standard deduction becomes extremely powerful. Because the standard deduction reduces your taxable income, it can effectively lower your combined income into a lower bracket. And that can change everything. It can mean the difference between paying tax on 85% of your Social Security, paying tax on 50%, or paying no tax at all. For seniors whose income is near these thresholds, even a small reduction can create a large difference in tax outcome. In some cases, that additional deduction can make thousands of dollars of Social Security income completely tax-free. And when you combine that effect with the direct tax savings from the deduction itself, the total benefit grows quickly. That is how the numbers begin to approach the $12,000 range over time, especially for married couples. For single filers, the benefit is typically smaller, but still significant, often in the range of $4,000 to $6,000 annually, depending on income. This is not a special loophole. This is simply how the tax system is structured. But the key detail is this: it only works if the numbers are calculated correctly. If your combined income is miscalculated, if the standard deduction is applied incorrectly, or if your return is prepared without attention to these thresholds, you may end up paying more tax than necessary. And that happens more often than people realize. Now we move to the third piece. And this is the part that almost nobody talks about. Even though millions of people technically qualify, it's called the credit for the elderly or the disabled. And it's one of the most underused tax benefits available. Now let's talk about the part that almost nobody claims. Not because it is small, but because most people simply do not know it exists. It's called the credit for the elderly or the disabled. And unlike deductions, which reduce your taxable income, this is a tax credit. That means it directly reduces the amount of tax you owe, dollar for dollar, which makes it far more powerful. To qualify, you must meet at least one of these conditions. You are 65 or older, or you are permanently and totally disabled and receiving taxable disability income. But eligibility doesn't stop there. This credit is designed for lower to moderate income seniors, so your income must fall below certain limits. For single filers, your adjusted gross income must be below $17,500, or your non-taxable Social Security must be below $5,000. For married couples filing jointly, your income must be below $25,000, or your non-taxable Social Security must be below $7,500. Now here is why this matters. Many retirees actually fall into this range, especially those living primarily on Social Security, small pensions, or limited retirement savings. But because the rules look complicated, and because tax software often does not highlight this clearly, it gets missed. The value of this credit can range from $3,750 up to $7,500, depending on your filing status and income. And in some cases, it can significantly reduce or even eliminate your federal tax bill. But here's the catch. You do not receive this automatically. You must actively claim it. And to do that, you need to file Schedule R with your tax return. If that form is not included, the credit is not applied. It is that simple. Now think about this for a moment. You could qualify. You could meet all the requirements. You could be exactly the type of person this credit was designed for and still receive zero benefit, simply because the form was never filed. That is why this remains one of the most overlooked tax advantages for seniors. And when you combine this credit with everything we discussed earlier, the higher standard deduction, the reduction in taxable Social Security, and now a direct tax credit, the total benefit starts to become very real, not theoretical, not marketing, but actual dollars saved. But we are still not done, because there is another layer. And this is where many people lose money without even realizing it. It has nothing to do with eligibility. Nothing to do with income, and everything to do with how the tax return is actually filed. This is where small mistakes can quietly cost you a lot. Now we get to the part where most people lose money. Not because they don't qualify, not because the benefit isn't available, but because of how the tax return is actually prepared. This is where small details quietly turn into real financial losses. The first mistake is assuming everything is automatic. Many seniors believe that once they enter their age into tax software or tell their tax preparer that all eligible benefits will be applied. But that is not always how it works. Some benefits are automatic, others are not. And the difference between those two can cost you thousands. For example, the higher standard deduction for seniors is usually applied automatically. But the credit for the elderly or the disabled is not. If Schedule R is not triggered or manually added, the system may skip it entirely. And unless someone is actively checking for it, it simply disappears. The second mistake is relying on overly simple tax filing. Many retirees choose the simplest filing option: basic forms, minimal inputs, quick filing, and while that may feel efficient, it often means the return is not optimized, because tax optimization requires looking at interactions between different parts of your income, not just entering numbers. For example, a small withdrawal from a retirement account could push your combined income just above a threshold. That one move could cause more of your Social Security to become taxable, which means you could end up paying more tax than necessary, even though your income only increased slightly. This is what's called a tax ripple effect, and it happens all the time. The third mistake is poor timing. Most people think taxes are only about what already happened. But in reality, taxes are also about when things happen. Timing income properly can reduce how much tax you pay. For instance, delaying a withdrawal by a few months, splitting income across 2 tax years, or adjusting how distributions are taken. These small decisions can keep your income below key thresholds, which protects your deductions and reduces how much of your Social Security is taxed. The fourth mistake is assuming past returns were correct. Many seniors file taxes the same way every year. And if nothing obvious goes wrong, they assume everything is fine. But tax laws change, thresholds adjust, and benefits evolve. What worked 5 years ago may not be optimal today, which means you could be repeating the same missed opportunity year after year. And here is the most important part. All of these mistakes are quiet. There is no warning, no alert, no message from the IRS telling you that you could have paid less. You simply pay what was calculated and move on. But once you understand how these pieces connect, the standard deduction, Social Security taxation thresholds, hidden tax credits, and filing strategy, you begin to see the full picture. And that picture looks very different from what most people expect, because this is not about finding a loophole. It's about using the system the way it was designed. Now that we've broken down the structure and the common mistakes, we can finally put everything together and show you what this actually looks like in real numbers. Now let's bring everything together. Because once you see how these pieces interact in a real situation, the impact becomes very clear. Let's walk through a simple example. Imagine a retired couple, both over 65. They receive $30,000 per year from Social Security, $20,000 from a small pension or retirement account. That gives them a total income of $50,000. At first glance, that might seem straightforward. But what matters is not just the total, it's how that income is taxed. Step one, calculate combined income. We take $20,000 pension income plus half of Social Security, $15,000. That gives a combined income of $35,000. For a married couple, this falls between the thresholds, which means up to 50% of their Social Security may be taxable. Step two, apply the standard deduction. Because both are over 65, they qualify for the higher deduction. That brings their total standard deduction to $30,700. This is critical because it reduces their taxable income significantly. In many cases, it can bring their taxable income close to zero. Step 3, apply potential credits. If their income falls within the qualifying range, they may also claim the credit for the elderly or the disabled. Even a partial credit can reduce their tax bill further. In some situations, it can eliminate it entirely. Now look at the outcome. Without understanding these rules, they might assume a large portion of their income is taxable. They might overpay, but with the correct structure, a significant portion of their Social Security may not be taxed at all. Their taxable income may be minimal, and their final tax bill could be far lower than expected. Now, expand that over time. Saving even $1,000 to $3,000 per year may not feel dramatic at first, but over 10 years, that becomes $10,000 to $30,000. Over 20 years, it becomes even more meaningful. And that is how these benefits quietly add up. This is why the original number up to $12,000 or more is not unrealistic. It is not a single payment. It is the combined effect of higher deductions, lower taxable Social Security, and overlooked tax credits working together over time. So what should you do next? Keep it simple. Make sure your age is correctly reflected on your tax return. Verify that the higher standard deduction is applied. Check whether your Social Security is being taxed correctly. And most importantly, confirm whether you qualify for Schedule R. If you are unsure, it may be worth reviewing a prior return, because if something was missed, you may still have time to correct it. The key takeaway is this: these benefits are not hidden, but they are easily overlooked. And in a system this complex, what you don't know can cost you. If this helped you understand how the system actually works, take a moment to subscribe, because small financial details like this can make a bigger difference than most people realize over time.
And if you want to see how a simple daily investment can grow into a portfolio that generates consistent monthly income, check out the next video on your screen.